Welcome to the Deep Dive. Today we are tackling an incredibly complex story from the consumer products world. We're looking at the dramatic restructuring of IG Design Group, specifically how they sold their massive U.S. division for just $1, which then immediately fell into Chapter 11 bankruptcy.
It's really a tale of two companies now. You have the U.S. subsidiary, Design Group Americas, or DGA, which is, it's being liquidated as we speak. And then you have the much smaller global parent company that's still standing and just reported its results.
And there's a real sense of urgency here. The deadline for claims and any disputes over the asset sales for that bankrupt U.S. entity is tomorrow, December 26, 2025.
Exactly. This whole thing moved with just brutal speed and efficiency.
Okay, so that $1 sale, it sounds like a total catastrophe, but as we dug in, we realized this was more like a necessary surgical extraction. Let's start with the part that was cut loose. DGA. They filed for Chapter 11 on July 3rd, 2025.
Barely a month after the parent company offloaded it. And that sale was to an affiliate of Hilco Capital for, yes, that symbolic dollar. Though, to be clear, the original parent company is still entitled to 75% of whatever cash is ultimately realized from the asset sales.
That price point, though, it tells you everything you need to know about the liability they were shedding.
It really does. And the Chapter 11 filing, it wasn't a reorganization. This was specifically a mechanism for a structured sale, a way to quickly sell off the assets across its four main segments: stationery, gift, sewing, and play.
And this wasn't a clean, one-and-done sale to a single buyer, right? It was a complex dismantling.
Oh, completely. A multi-party breakup.
Huh.
The court approved the sales in pieces all through September. It's actually worth breaking down where some of these brands went because it shows you how fragmented it was.
Yeah, let's do that. Where did the craft and hobby stuff end up?
Okay, so Advantage Corp picked up some of the biggest names in the play and sewing segments.
Mm-hmm.
We're talking about the Perler bead brand, super recognizable, and the Dimensions Needlecraft portfolio.
And what about the more traditional side, like gift wrap and stationery?
That was split up even more. WIFEA Holdings took parts of the gift and stationery lines, including the Burwick ribbon products. Then the CVC Group got the CR Gibson and the gift wrap company brands, a huge part of the market right there.
So every piece found a home?
Almost every piece. Carousel Worldwide took a calendar business, like the Lang lines. Even a huge competitor, American Greetings, came in and bought some specific gift wrap machinery. But there was one big casualty.
What was that?
The domestically manufactured woven ribbon business that was explicitly marked to be wound down, just gone. It shows this wasn't just about selling brands, it was about killing off operations that were just fundamentally broken in the U.S. market.
Okay, so that's the fate of DGA. Now let's turn to the survivor, IG Design Group Polaris. Their first results post-surgery, for the 6 months ending in September, they look pretty rough. Revenue was down 13% to about $131 million.
And if you dig into the profit, that's where you really see the pain. Adjusted operating profit, it plunged 56%. It went from almost $13 million down to just $5.7 million. That's your margin getting squeezed from like 8.6% down to a wafer-thin 4.3%.
Right, so even though they cut out the tumor, the remaining body was still feeling the effects. Net cash also dropped significantly, from over $7 million to under $2 million, and yet management came out and reaffirmed their full-year guidance. They're still projecting revenue of $270 to $280 million.
That seems optimistic.
It does. It feels like a major disconnect. And their confidence hangs on one single thing, their order book. They say they have visibility on 96% of their forecast sales for the second half. The argument is that the leaner European and Australian businesses are just much more predictable now that the U.S. chaos is gone.
To really get why this was such a relief, you have to go back to just how toxic DGA had become. The sale to Hilco happened on May 30th, and the parent company immediately booked a loss of $140 million on the sale itself. And that's before another $10 million in trading losses from DGA right before they sold it. So $150 million hole. That loss tells you just how desperate they were. And we know it was because of three huge pressures that all hit at once.
The first one was just a killer, the liquidation of one of their biggest customers, Joann's Stores.
Exactly. Losing any customer is bad, but Joann's Stores was unbelievably critical. They represented $27.4 million in revenue for DGA last year. That's more than 5% of their entire top line.
Wow. For a seasonal business that needs to build up huge amounts of holiday inventory.
It's a death blow. Losing that much cash flow overnight, especially when your margins are already thin, you just can't survive it.
And what was the second pressure point?
New trade tariffs that came in during 2025. DGA sourced so much from overseas, and these tariffs just jacked up their costs instantly. This put them in a horrible position with their other retail customers who, refused to pay more.
So costs go up, but you can't raise prices.
Right. And because the tariffs were implemented so quickly, no one could forecast anything.
Right.
Retailers just started cutting orders because they couldn't plan. You add that to the third pressure, the overall macro climate, cautious consumers, high working capital needs, and they were just completely choked.
And we should remember, they tried to fix this. This wasn't a surprise. The restructuring efforts before the sale were massive.
They were. They threw the kitchen sink at this. They exited 12 different sites, moved manufacturing to Mexico, cut almost 200 jobs. And even after all of that, revenue still fell 16% in the prior fiscal year. The headwinds are just too powerful.
So Hilco steps in, and they immediately have to fund the bankruptcy process itself. They put up $53 million in what's called DIP financing, which gives you a sense of the cash crunch. But the debt they were trying to manage was estimated at over $100 million in unsecured liabilities.
And we can't talk about this without mentioning the human cost. It was immense. DGA sent out mass layoff notices in June. A total of 845 employees lost their jobs. That's about 60% of the entire workforce at the time.
A huge social cost. And it wasn't just factory workers, right? It hit the creative side of the business hard, too. All those designers who had royalty contracts for the sewing patterns and craft lines.
Yeah, that's a classic bankruptcy story. The designers, the people who create the intellectual property for brands like Simplicity and McCall's, they're just unsecured creditors. They get pushed to the back of the line. Reports said there was very little communication, leaving them scrambling to figure out how to even file a claim for royalties they were owed. It's just a mess.
Okay, so DGA is dissolved, assets are sold off. Let's pivot back to the company that's left, the continuing IG Design Group. It's a much simpler business now.
Much more focused. It's now just 3 regions, all outside the U.S. You've got DG Europe, which is the biggest at 45% of revenue, then DG UK at 38%, and DG Australia at 17%. And looking at how differently they all performed is, I think, the best proof that this new model can actually work.
Well, let's start with DG UK, because that was the weakest link in the first half. Revenue down 30% and operating profit. It fell 90%, a 90% drop. What happened there?
Some of it was just softer UK demand, but the lion's share of the blame goes right back to those U.S. tariffs we talked about. It created a knock-on effect. A major U.S.-based customer that sources through their UK unit cut back orders, which just crushed the UK margin down to almost nothing. It proves that even with the sale, the U.S. contagion wasn't completely contained.
Okay, and Europe was more stable on the top line, but their margins also took a hit.
They did. They dropped about 200 basis points. But that was more of a deliberate choice. They were investing in competitive pricing to hold on to market share with the big European retailers. So painful, but strategic.
Which leaves the one real bright spot, DG Australia.
Australia was the success story. Revenue up 8%, and their adjusted operating profit soared 54%. Their margins are now really healthy. That was all driven by growth in their party products, which are higher margin. They also pulled off a big warehouse move successfully. Australia is really the proof of concept. A focused regional business can absolutely thrive when it's not being dragged down by the U.S. supply chain monster.
Let's talk about the financial engineering behind this. They got a new financing facility in July. Why was that so important?
This is key. They replaced their old asset-backed lending facility with a new receivables finance facility. The old facility would have almost certainly had what are called financial ratio covenants.
Like your debt can't be more than X times your earnings, that sort of thing.
Exactly. And when you're going through a massive crisis like this, you are almost guaranteed to breach those covenants, which triggers a technical default. It's like a sword of Damocles hanging over your head.
I see.
By moving to this new facility, which only has operational covenants, they essentially remove that sword. It gives them breathing room to manage the recovery without worrying about a technical default. A very smart strategic move.
And they've suspended the dividend for now, but plan to bring it back. They're also planning to switch their reporting currency from US dollars to British pounds.
Which is symbolic, but it makes perfect sense. With DGA gone, their US dollar exposure is tiny. The company's center of gravity is now firmly in the UK and Europe.
So the path forward seems clear. Focus on execution, push for higher margins, and strengthen the business in their core regions.
It's the ultimate de-risking play. They took one massive, painful hit to get a clean break, and now the remaining business can focus on what it does best.
All right, that brings us to our final segment. And a reminder for everyone listening, this is purely a conceptual discussion. It is definitely not financial advice.
Right, so given the complete chaos of the DGA breakup, with all these assets split between a half dozen new owners, Here's our outrageous but plausible trade idea. We know all those major brands, the Big Four sewing patterns, Perler beads, Burwick ribbons, they're all under new management. WIFEHA, Advantas, CBC, and so on.
Which means you suddenly have 6 or 7 brand new, totally separate supply chains trying to get up and running at the same time.
Exactly. And our thesis is that the market sees these asset sales as a clean break, a smooth handover. But that's impossible. The complexity of moving all those brands, contracts, and distribution with 60% fewer staff, it guarantees a logistical air pocket. We think there's a huge risk of quality control problems or shipping delays in the first half of 2026.
So where's the actual trade?
The trade is a short play on specific, smaller, publicly traded craft retailers or suppliers that, relied heavily on that DGA supply chain. Think about companies whose core business depends on having a steady supply of, say, very specific sewing patterns or craft components. Shorting those smaller exposed companies now before those logistical problems show up as inventory shortages in their Q1 or Q2 earnings reports. That's where you might find an asymmetric risk-reward. The problem is hidden, but it's coming.
So the core insight of this whole deep dive really is that the story isn't about IG Design Group's bad first half results. It's about the stunning success of their de-risking strategy. They cut loose an unprofitable U.S. anchor right before the retail seas got even stormier.
And as you think about that, just remember the immediate timeline for everyone still caught up in the U.S. entity. That claims and sale dispute deadline is tomorrow, December 26.
Our final thought for you to chew on. Of all the pieces that were sold off, stationery, gift, sewing, and play, which new owner do you think got the best deal for the long term, and which one inherited the biggest headache?
Thanks for joining us for this deep dive into the separation of IG Design Group Americas. We'll see you next time.